In this section, we will take a look at what is the stock market in its most basic and simplest form. Yes, it might sound very easy. It is actually very easy, and that is the same reason people like to overcomplicate things. So for me, I'm going to teach you guys what is the stock market in its most basic form so that you guys know what are the things you need to focus on and the things you need to ignore. So what is the stock market? At its core, the stock market is simply a marketplace where the buyers and the sellers of stocks come together. It is important to keep this definition in mind because we often tend to overcomplicate things with external noise like indicators or the opinions of other traders. So stock market is simply a marketplace for stocks. Forex market is a marketplace for forex. Futures market is a marketplace for futures, and this definition applies to every other market. For example, if you want to buy an apple, say for example, you will have to go to a supermarket. It's also a market where you can buy groceries, you can buy apple, you can buy soap, you can buy dishes, whatever. Similar to that, a stock market is just a marketplace for stocks, similar to forex market and futures market. The fundamental truth is straightforward. There's always buying and selling happening in the stock market, and this is the marketplace of stocks. So I want you guys to understand this. Why? Because, for example, if you want to go to a store, a grocery store, a supermarket, and you want to buy an apple, do you ever think about what is the MACD of that apple doing? Or what is the RSI of that apple doing? Or what is the Fibonacci retracement of the apple doing? Say, for example, apple price went from $5 to $15, then it comes back to $10. Are you going to be like, okay, it's retracing 50% Fibonacci level, now is a good time to buy? That's not how you think. And that is why I want you guys to understand that at its most basic fundamental truth, the stock market, it's just made up of buyers and sellers. It's not made up of indicators. Yes, we will learn how to use indicators to our advantage and how to use them. But the stock market, and as like any other market, is made up of buyers and sellers. That means the buying, the demand of something outweighs the supply, the price rises. That is a fundamental truth. It doesn't move based on indicators. When the demand is high, the price is going to go up. When the demand outweighs the supply, the price is going to go up. When the supply outweighs the demand, the prices are going to fall. So it also depends on the sentiment of the buyers and the sellers. If the buyers want to be aggressive, the price is going to go up. If the sellers want to be aggressive, the price is going to go down. Doesn't matter what the indicator is doing. Again, I will teach you how to use indicators to your advantage. But as the most basic fundamental truth, stock market is a marketplace for stocks, and it comprises of a buyer and a seller. So our focus will be on learning how to read and understand the sentiment instead of getting distracted by the noise. That is the indicators, the moving averages, the Fibonacci levels, like all these levels. Yes, there is a place on how to use it and how to kind of supplement your trading with these indicators. But as the fundamental truth, because whenever you search on Google, what is the stock market, how to trade the stock market, I'm telling you 90% of the videos are gonna start with an indicator, and that is why in the very first class I want you guys to understand that what is the stock market. Think of it like your local grocery store. As I mentioned, if prices rise because of inflation or shortages, it's the same basic principle of demand and supply at play. So now let's take an example. I gave you guys an example of Apple. Now take an example of Apple iPhone. When Apple releases a new iPhone, demand is extremely high. Whenever we see a new iPhone, the pre-orders are live. Whenever they launch the iPhones, there are like no discounts. You can't find any discount because the demand is so much that supply is trying to catch up with the demand. So you guys won't see discounts on your carriers, or if you buy it from Apple directly, you won't see any discounts. Early buyers are willing to pay the full retail price and sometimes even premiums in resale markets. So usually iPhones are launched in September. And for the first 2 months, September, October, November, mid, you don't see any discounts. And then on a good year, if the demand is not that high, during Black Friday, Cyber Monday discounts, New Year, Christmas discounts, holiday season, in January, February, you get a lot of discounts. But after a few months, as the initial demand cools down and supply catches up, eventually you will be like, at first the demand is really high. So if you look at the graph, the demand is very high and the supply is right here. So it's trying to catch up. They are trying to find a middle ground, and that is what happens after a few months. After a few months, the demand is maybe right here and the supply is a lot. So after a few months, you can directly go to an Apple store and buy the iPhone or whatever you want. But for the first few weeks, you have to place the pre-orders. You have to wait in line. You have to go to a store, wait in line. It's a big hassle because the demand is a lot. And after the demand settles down, you get discounts. So the price actually comes down. If you buy it directly from the Apple store, you won't get any discounts, but after a few months on Amazon or maybe your carrier, if you go with like Verizon, AT&T, you will find a lot of discounts if you buy the phone after a few months, because the supply is now a lot more than the demand. This is the same supply demand dynamic that drives the stock prices. Higher demand, higher prices; lower demand, higher supply. That means the demand is lower, the supply is higher, that causes lower prices.